$250,000 is where banks stop charging you for wires. $1 million is where they start giving you a real person to call. And at $10 million, the whole game changes, because suddenly they're not just selling you products anymore, they're building things that basically don't exist for regular clients. And somewhere in that ladder, your financial life quietly flips. Not because you got lucky, because you crossed a line nobody bothered to put on the map for you. So the big question is simple. Where are you on that map right now? Because that's what this video is really about. Not just perks, not just premium banking nonsense. I'm talking about 3 completely different layers of access, 3 different product menus, and a compounding gap that can turn into millions over time. And the weird part? Most people never learn this stuff. Not because it's hidden in some vault, but because the bank has zero incentive to explain the better menu while you're still profitable on the cheaper one. By the way, I built a free early retirement calculator because most of the ones online are, honestly, kind of trash. They use average returns without properly modeling sequence risk the way firms like BlackRock and Vanguard actually do it internally. It shows you the weak spots in your plan. I only ask for your email so I can send the report, because I don't store your financial data in the calculator itself. Links in the description. Now keep this one idea in your head the whole time, because I'm going to come back to it again and again, and every time it'll sting a little more. Picture a restaurant. You walk in, get handed a menu, order, eat, leave. That's how most people treat money. They assume there's one menu, one set of choices, one normal way to do things. Except there isn't. There's a second menu, not a fancier version of the first one. A totally different set of options, with different ingredients, different rules, and different prices, available only once you hit a certain number. And above that? Yeah, there's a third menu too. Most people on the second menu don't even know the third one exists. That's the hidden menu problem. And every time I explain this, I see the same reaction. First, skepticism. Then, recognition. Then this very specific kind of quiet rage, which is honestly understandable. In a minute, I'm going to show you the tax strategies that private banking clients above $1 million use all the time. They're legal, they're documented, and they're basically off limits until you're wealthy enough to be treated as qualified enough to hear about them. But first, let's talk about the fee problem, because this is where a lot of people think they've got it handled, and they really don't. There was a retired teacher in Ohio, okay? 30 years of saving into a 401k, then rolling it into an IRA at retirement, then working with a local advisor who charged 1.2% a year on a $400,000 portfolio. And she thought that was pretty reasonable. She'd seen funds charging 1.5%, 1.8%, even more. So 1.2% felt almost polite. That's the trap. Because 1.2% of $400,000 is $4,800 a year. That sounds like a service fee. It sounds manageable. But fees don't really live in the present. They live in the future. At 7% annual growth, $400,000 compounded for 20 years becomes about $1.55 million with no fees. With a 1.2% fee, so a net return closer to 5.8%, it becomes around $1.20 million. So that small fee didn't cost her $4,800 a year. It cost her roughly $350,000 in wealth. That's not a subscription. That's a retirement haircut. And here's the part that makes people blink. If that same $400,000 had only been charged 0.1% instead, it would have ended up around $1.50 million. Same market, same starting point, same time frame, way different result. That gap exists because mutual funds often come in different share classes. The version regular investors get through a standard brokerage account usually costs more. The institutional version, the one pensions and endowments use, is cheaper. Same manager, same underlying holdings, different price because of who walked in the door. And the threshold where institutional-style access starts opening up in a meaningful way is around $1 million in investable assets. Below that, you can still get excellent low-cost index funds through firms like Vanguard or Fidelity, and you absolutely should if that fits your situation. I use them too, a lot. But I need you to hear this. Index funds are not the full game. They're excellent, but they're still the first menu. The institutional tier is a different animal. And that brings me to something else most retail investors never get told. Fees are negotiable. A 0.75% advisory fee at $500,000 might sound normal. It's not the only price. With a fee-only registered investment advisor, not a broker, not some commission-driven salesperson, you can often land closer to 0.40% to 0.50% at that level. And if you're at $1 million, 0.20% to 0.30% is very realistic if you actually ask. That difference between 0.75% and 0.30% on $1 million over 20 years can preserve roughly $340,000. That's one conversation. One. And most people never have it because nobody told them the number was flexible. Quick side note, if you like this kind of content, hit subscribe, because YouTube can absolutely decide to bury my videos just because the little engagement gods are in a mood. The algorithm and private banking do have one funny thing in common. Both reward signals of loyalty and activity, which is either hilarious or deeply annoying depending on the day. All right, I want to introduce two cousins. Let's call them David and Marcus. Same age, same income path. Both started working at 28. Both made low six figures. Both maxed out their 401k. Both invested consistently. Both hit $1 million in investable assets around age 40. On paper, they look identical, but the moment they crossed that $1 million line, their financial lives stopped being the same. David stayed where he was. Good low-cost investing, no drama, no bad decisions. By any normal standard, he did great. Marcus got a phone call. His bank saw the asset level, and suddenly the conversation changed. They offered him a different tier. I'm going to come back to these two at the end, because the ending is not what most people guess. But everything from here to there explains why it happens. Stay with me, because this next part is where the system gets a little spicy. When people hear private banking, they usually imagine a nicer chair, softer lighting, and some polished relationship manager who remembers your birthday. And honestly, at the Chase private client level, which starts at $150,000 in qualifying deposits and investments, that's mostly what you get. No wire fees, no ATM surcharges. Someone answers the phone. Useful? Definitely. The real value, though, is not the free coffee and the smiling banker. It's what starts showing up behind the curtain. One of the first legal gates is accredited investor status. To qualify, you need either $1 million in net worth, excluding your primary residence, or $200,000 in annual individual income, or $300,000 jointly for the past 2 years with a reasonable expectation of the same going forward. Only about 13% of American households meet that. And what does it unlock? Access to investment categories that the other 87% cannot touch. Private placements, hedge funds, structured under Regulation D, private real estate syndications, direct lending funds. These aren't some weird secret instruments from a conspiracy forum. This is a huge part of global finance. Private equity alone is a roughly $30 trillion asset class worldwide. Private credit in the U.S. is around $1.70 trillion, and growing fast. And the return differences are not trivial. Cambridge Associates data shows top quartile private equity funds have averaged about 14% to 15% annually since the 1990s. The S&P 500, over the same period, has averaged around 10% to 10.5%. That extra 4% to 5% a year sounds small until you actually run the math. On $1, million over 20 years. That can mean the difference between about $6.70 million and $10.80 million. That's a $4.10 million gap. And retail investors are effectively locked out, not because the products are fake or evil, but because securities law draws a line and says, above this level, you're presumed sophisticated enough to understand the risk. Now, there's a level above accredited investor that even fewer people talk about: qualified purchaser. That threshold is $5 million in investable assets. At that point, a whole new set of hedge fund options opens up. So do direct co-investments alongside institutional money, and certain municipal bond auctions, the kind that large pensions and foundations participate in, become actual options. Most retail investors don't even know those auctions exist. Not because the information is secret, exactly, more because the invitation never landed in their inbox. That's the thing about these tiers. Every time you cross one, the menu changes. And you don't always realize the old one was incomplete until somebody hands you a better one. Then there's the third menu. At $10 million, you're in a different universe. JP Morgan Private Bank, Goldman Sachs Private Wealth Management, Citi Private Bank. Goldman's official minimum is $10 million, but the really meaningful senior-level conversations usually happen closer to $20 million. Citi Private Bank is more like $25 million. And at that level, the difference isn't just more choices. It's authorship. I've heard this story in different versions from people inside wealth management, but the message is always the same. A client with a couple million asked what the difference was between his service and the service for someone with $50 million. The answer was basically, with you, we help choose the right product. With them, we design the product. That's the shift. The legal entity, the leverage, the exit terms, the tax structure, the liquidity schedule, all tailored to one household. Below that level, you're buying financial products. Above it, you are the blueprint. And if that sounds ridiculous at a dinner party, it should. Try saying, at a certain wealth level, banks start creating custom investments for you. People either think it should be illegal or that it already is. It's not illegal. It's heavily regulated. The SEC helped build the framework. Now let's get to the part that makes all of this feel a little less theoretical and a lot more unfair. In 2021, ProPublica published an analysis based on IRS records showing that the 25 richest Americans saw their combined wealth increase by about $401 billion between 2014 and 2018, while paying about $13.60 billion in federal income taxes over that period. That works out to an effective rate of about 3.4%, not 3.4% of income. 3.4% of wealth growth. And the reason has a lot less to do with cheating the system and a lot more to do with how the tax code defines income. Plus, one strategy that becomes extremely powerful at high wealth levels. It's called buy, borrow, die. Very blunt name. Very accurate name. Here's how it works. You buy assets that tend to rise in value. Stocks, real estate, private company equity. You do not sell them, because selling creates the taxable event. Instead, you borrow against them. Banks will lend against portfolios at rates roughly between 3% and 5%, using securities-backed lines of credit. The cash you borrow is not income. It's not taxable. It's just a loan. So your assets keep compounding. You keep living off borrowed money. And then, when you die, your heirs inherit the assets at the current market value under the stepped-up basis rule. That means the embedded gain, the whole chunk you never sold, can disappear from taxation entirely. Here's the math in plain English. You buy $5 million of diversified stocks. 15 years later, it grows to $12 million. You've got a $7 million unrealized gain. If you sold, and long-term capital gains tax is 15%, you'd owe about $1.05 million. Instead, you borrow $4 million against the portfolio at 4% interest. So that's about $160,000 a year. You get liquidity without selling. Your portfolio keeps growing. You never trigger the tax bill. Then you die. Your heirs inherit at the stepped-up value. The gain vanishes from the tax system. The loan gets repaid from the estate. The math just closes itself out. And the bank is not doing charity. They're making a very rational lending decision. Liquid collateral, low risk, steady interest income. That's why securities-backed lending becomes much more accessible above $1 million in investable assets. The terms get better above $5 million. And above $10 million, banks actively compete for that relationship because the interest income is worth it to them. Below $500,000, though? Different story. The minimums are tougher. The offers are worse. A lot of private banks won't even bother starting the conversation because the economics don't make sense for them yet. So the real issue isn't just do I have enough money, it's do I know what each amount unlocks? Those are not the same problem. One is about accumulation. The other is about architecture. And architecture matters a lot more than people think. Because if you understand the threshold, before you reach it, you can prepare for what comes next, instead of spending 10 years on the wrong floor. Let me make this real. Say you're 43 years old. You've got $850,000 in investable assets, about $550,000 in a taxable brokerage account, and $300,000 in retirement accounts. You make $160,000 a year. You max your 401k. You invest in a low-cost index strategy. By normal standards, you're doing really well, but you're also paying 0.80% in advisory fees on your taxable account. You own an S&P 500 ETF, which is a solid choice, but because it's a fund and not direct stock ownership, you can't harvest losses at the individual security level when sectors rotate. Last year, when you needed cash for a home project, you sold $42,000 of appreciated shares and paid around $6,300 in capital gains taxes you could have avoided with a different setup. And because you're not yet fully accredited on a net worth basis, no one has really introduced you to private market allocations. Now, fast forward that same person to age 60, under two scenarios. Scenario 1, nothing changes. At a 7% gross annual return, the taxable account grows to roughly $1.60 million. The retirement accounts grow to about $1.10 million. Total at retirement, around $2.70 million. That's solid. That's strong. Most people would be thrilled. Scenario 2. You cross $1 million in investable assets at age 46 and make 3 moves. First, you switch to a fee-only RIA and negotiate the advisory fee down to 0.3%. On a $1 million taxable account, that saves about $5,000 per year in direct fees, which compounds into roughly $120,000 in preserved wealth over 14 years at 7%. Second, you implement direct indexing in the taxable account, so instead of owning the ETF wrapper, you own the underlying stocks directly and can harvest losses more precisely. Vanguard's research has estimated around 0.75% to 1.1% in annual after-tax return improvement from that strategy. Use a conservative 0.9% over 14 years on a $1 million taxable account, and that adds about $190,000. Third, you allocate 15% of the taxable portfolio, or $150,000, into accredited investor private credit funds that pay 7% to 8% annual distributions instead of the 4% you are earning on the bond side. Over 14 years, that return difference adds about $95,000. Put it together and you get about $405,000 in additional wealth, not from picking some magical stock, not from taking huge risk, from finally operating on the second menu. That's the whole point. And now, let's bring David and Marcus back. 20 years after they both hit $1 million at age 40, David ended up with about $3.40 million, which, again, is genuinely excellent. He did a great job. He used the tools available to him and stayed disciplined. Marcus ends up at about $5.10 million. The $1.70 most of the time that he figured out had never been fair. Most of them were some kind of sacks. He set to late $1.10. Marcus ends up at about $15 billion. It came from fee compression, compounding over time, direct indexing tax savings year after year, a private credit allocation that out-earned David's bond position, and one well-timed use of a securities-backed line of credit that let him avoid selling appreciated shares and saved roughly $90,000 in capital gains taxes in a single move. That's it. No secret brain. No, I see some of the matters in which you can see more, because you can also have the work with paper. Just different tools, unlocked by a threshold, used by someone who knew to ask. So here's what you should actually take from this, based on where you are. If your investable assets are between $250,000 and $1 million, right now, your highest leverage move is to find a fee-only registered investment advisor. Not a broker, not someone on commission, a fiduciary. And negotiate the fee directly in the first meeting. At $500,000, getting to $500,000 to 0.5% is absolutely realistic, if you ask. On $500,000 over 20 years, the difference between 1% and 0.5% is about $175,000. One question. That's it. If you cross $1 million in investable assets, the two conversations you want immediately are direct indexing for your taxable account and securities-backed lending. And if your advisor doesn't bring up direct indexing on their own once your taxable assets get large enough, that tells you a lot about the level they actually work at. And if you're approaching $5 million, treat qualified purchaser status like a real planning milestone. Not just, cool, I'm rich now. I'm talking tax planning, entity structure, estate planning, all of it. Ideally, with a tax attorney and an estate planner working alongside your advisor before you get there, not after. Because people who plan for the threshold extract way more from it than people who just stumble into it and spend the first year trying to figure out what changed. That's the annoying truth here. Lazy investing built more wealth than hustle myths ever did. The people who won quietly weren't trading faster or working harder or finding mystical information no one else had. They understood which floor they were on. They knew when to ask for the other menu. And the system? It usually upgrades you on its own schedule, when the upgrade matters a little less than it would have earlier. That's how it likes to work. So ask before they decide you're ready. Go ask your banker what tier you're in right now, and watch how long it takes them to answer.